So in Canvas, miscellaneous info, it says link to whiteboard images. You can click on that. There's a bunch of different whiteboard images from different topics that some of them you'll be familiar with because they're similar to ones that I've written up here already. But this one I'm particularly proud of, so that's what how we report income and expenses for rental properties depends on how much time we rent it out and how much time we use it personally. So we've got 3 different determinations of usage that are possible. We've got primarily personal, in which case we have no rental income and no rental expenses. None. This is one of those rare moments where they say you don't have to declare the income, but you also don't get the expenses. Okay, so no income, no expenses. We could also have what's called personal. Oh no, it is rental. Rental/personal. So in this case, it's part of both. Okay, so it's kind of a combination. In this case, we claim the rental income and we claim the rental expenses, but rental expenses only up to 0 rental income. So it cannot create a loss. So if our rental expenses are our income is $10,000 and our expenses are $12,000, we only get to take $10,000 of expenses. It can only bring us to 0. It cannot give us a loss. The third is primarily rental. If it's primarily rental, we can take the income and we can take the expenses and we can take the losses, as long as we qualify under those passive income rules, but we'll assume that we do. All right, so how do we determine which one we are? Because that's going to determine, again, how we treat the income or any potential losses. All right, so the first thing you have to do is ask, how many days was it rented? How many days did we rent this property? If it was less than 15 days during the year, stop is primarily personal. Okay, so 15 days rented. Sorry, less than 15 days. So up to 14 days. So if it was less than 15 days, you don't have to do anything else. Doesn't matter if that income was $50,000. You don't have to claim it, right? Which is kind of cool if you live in an area and your book gives you the example of somebody who lives like in Augusta, Georgia, and they rent their house out to people who are visiting for the what do I call that? The Augusta Invitational or whatever that is, like golf tournament. They get $10,000 for the week for their house. Then they don't have to claim any income on that. It's just free money. All right, but if it is rented for at least 15 days or more, then we have to determine whether it's rental or rental personal or primarily rental. Then it's going to be one of these two. So 15 days is the magic number. Less than 15 days, personal. Don't have to claim the income. You also don't get to claim the losses, but more than 15 days, then it's going to be one of these two. Step 2, calculate 10% of the rental days. So if we rented it for 30 days, 10% of that is 3 days. All right, so that's the first step, 10% of rental days. Step 3, choose the larger of 14 days or step 2 results. Well, 14 days is larger than 3. 14 is bigger than 3, so it would be 14. Is step 3 less than the number of personal use days? So now you got to bring in how many days did I use it myself. So my step 3 result is going to be 14 days. If I used it for, let's see, personally, let me think here. So I said, may have to write this down so I don't forget. So step 2, and I said 30 days. So step 2, 10% is 3 days. Step 3, I want the larger of 14 versus 3, right? 14 is the larger of those two. Step 4, is the step 3 result less than the number of personal use days? So let's say our personal use days were 30. So is the step 3 result less than, that's less than, right? Yes, number of personal use days. Yes, then it's rental personal. So if personal use, we take 30 versus 14. 30 is greater, so the answer to this, so the answer to this is, well, yeah, it's yes, because our personal was 30. So it's personal slash rental slash personal. If the answer is no, then it's primarily a rental property. So let's look at a couple of scenarios here. Let's say we had personal days equals 27 and rental equals 200. All right, so using these steps, how many days was it rented? Was it rented for less than 15 days? No. So we're gonna have to go to step 2. Calculate 10% of the rental days. So 10%, 200 times 10% equals 20. Step 3, choose the larger of 14 days or step 2 result. 20. Is step 3 less than the number of personal use days? Yes. So that's less than, yes. Well, that should be step 4, sorry. Yes. Equals personal slash, or rental slash personal. Now, let's make this, so personal use was 27, rental was 330. Now this becomes 33. So personal is 14 days, which is larger of 14 days or step 2 result, 33. Step 4, is the step 3 result less than the personal days? No. Then it becomes a rental. 100% rental. Okay? So there's that. That's up there, like I said, it's on the Dropbox. I'll show you where that is. The whiteboard images. So, oh, second thing right there. And there's a bunch of them up here, like I said. So average tax rate versus marginal, capital assets versus business assets, components of depreciation, remember all that stuff? The depreciation conventions, medical expense deduction, netting short-term and long-term capital gains. Maybe I should have looked at this before I started my qualified dividends calculation. All that jazz. All right. So, and that, to me, it's a little bit easier to put a flow chart together than to try and think my way through this up here. But if it's not used for more than 14 days, and it is rented for, I think it's easier to start with this one. Is it rented for more or less than 15 days? Because then you've got a clear answer. If it's rented for less than 15 days, then it's primarily personal. Stop, that's it. And then if not, then it's gonna be one of these two here. So we got Jose, owns a cabin in the mountains, rents the cabin for ski season, uses the property for personal use for 13 days. The cabin would be categorized as primarily rental property. If he used the property for personal use, because he's renting it for 4 months, that's obviously more than 14 days or more than 15 days. If he used the property for personal use for 21 days, it would be categorized as personal/rental. If he rented the cabin for less than 15 days, it would be categorized as primarily personal. So what is considered personal use of a dwelling? Taxpayer, any member of the taxpayer's family, or any person with an interest in the unit uses it. So even if it's not you, if it's your brother or your mother, somebody, then it's considered a personal use day. Any individual who uses the unit under an arrangement that enables the taxpayer to use some other dwelling unit. So if you're exchanging properties, any individual, unless for such day the dwelling unit is rented for its fair rental value. So if you're renting it out for something less than its fair value, that would be considered a personal use day. Let's see, any family member uses the rental property. Oh, family is defined brothers, sisters, spouse, ancestors, lineal descendants. Any day spent working substantially full-time repairing and maintaining the property does not count as a personal use day, even if other family members are using the property for recreational purposes on the same day. So if you're in a bind and you need it to not be a personal use day, then you can make sure that you're doing some work on it. Let's see, I think we already talked about this. Yeah, so primarily rental use, you get the expenses, and you can take a loss up to the passive activity loss limitations. Primarily personal, there's no deduction for expenses, but you do not have to include the rental income in income, so you don't get taxed on it. This is the example of Augusta. Masters, that's what it is, the masters. Rental property, again, you get you have to claim the income and you get to claim the expenses, but only up to 0. You don't get a loss for it. Let's see, what else? Well, this is just a different way of presenting that information. Okay, so how do we claim the expenses? Because that could get a little bit tricky. Like if you're using it personally for if it's a personal/rental property, you have a couple of different ways that expenses might be divided up. One is based on this time factor. Like if you're using the property for half of the year for rental, but half of the year for personal, and you've got to split up the expenses between the two, how do you do that? I mean, you're not entitled to, you know, the mortgage interest. Half of the year you were using it personally. So half of it should go on your Schedule A, right? And then the other half could go on the Schedule E. So how do we do that? There are a couple of different methods, and I've got a slide up as well. Maybe I'll pull that one up, a Dropbox, a whiteboard image on Dropbox to show the difference between these two. So there are couple of different ways of how we allocate expenses when we've got one property that's been used for multiple purposes during the year, partially personal, partially rental. We got the IRS method, and what we do there, expenses are allocated between personal and rental days based on the ratio of the number of rental days to the number of days used. So these are all of the expenses, everything. So if we used it for, here we go, personal for 26, rental for 330, then we would have to take the proportion of those personal use days to the rental days, the total number of days used. So we would have to add these two together. So it was used for, 357 days, and the rental days are 330. Whoops, I did that wrong. 330 divided by 357. So we figure out what that percentage is. So 92.4%. So that means our expenses, we're going to take whatever the total was, we're going to take 92.4% of those expenses. So 92.4% of the mortgage interest, 92.4% of the property taxes, 92.4% of the insurance, right, is going to be a expense on the Schedule E. So you can do it that way. There's also the tax court method. In this method, you treat the interest and the taxes a little bit differently. So the interest and the taxes on the rental property are allocated based on the ratio of the number of rental days to the total number of days in the year. Because really, interest and taxes are going to be applied for 365 days. You know, when you're talking about utilities, yeah, you're going to pay a little bit of utilities when nobody is there, but it's going to be a lot less. There's going to be a much reduced amount. You're not using the property for any purpose, so that expense might not apply. Whereas with interest and taxes, that applies whether you're there or not, right? And it applies equally whether you're there or not. The remaining rental expenses would be allocated using this other method based on the total number of days. So in this case, what changes is the denominator. But the denominator only changes when we're calculating interest and taxes. So if we have, and let me pull up that other form. Let's see if it's at all helpful. Right here. So with the IRS method, you're going to take the number of days that it was rented divided by the total number of days that it was used, multiply it by the expense. And that's how much expense you're going to take on your Schedule E. With the tax court method, and you can guess that where that came from is there was a lawsuit. Somebody went to court, right? And they determined that, okay, we can do this other method as well, but you can choose between the two. For all expenses except for taxes and interest, we're still going to use this method. But for taxes and interest, the denominator is not gonna be the total number of days it was used, it's gonna be 365. Or 366 if it's a leap year.
Say that again.
So, which part?
The denominator would change if what?
Okay, so if you're using the tax court method, the denominator changes to 365, but only with regard to these expenses, taxes and interest. All the other expenses, same denominator, total number of days used. So let's do an example. Okay, so let's say that we had days rented, days used. So we, total days used. So we rented it for 47 days and we used it for 200. And it was just vacant the other days. Okay. And our total expenses, let's do it this way. Interest was 10,000. Taxes were 5,000. Other expenses were, I don't know, 8,000. So if we're using the IRS method, the IRS method. What we're gonna do is we're gonna take the number of days rented, 47, divided by 200, times, what do we have here, 23,000? 23,000. $54.05. These are our expenses, our deductible expenses. Tax court method, we're gonna take 47 divided by 200 times 8,000, all the other expenses. And then we're gonna take 47 divided by 365 times 15,000. We're gonna add those together. So, 47 divided by 200 times 8,000, 1880. And then 47 divided by 365 times 15,000. We'll call it 1932. 3812 for deductible expenses. Which makes sense that it's going to be smaller because you have a smaller proportion here. You're not, instead of this 15,000 being like 23%, now it's like 12%, something like that. I can't remember the numbers exactly, but. So those are the two different ways that you can calculate that. And it, like I said, it all has to do with that denominator, which denominator you use. But the only difference is the taxes and interest. Let's see. certain things, like the travel expenses, you wouldn't include that in there, because that's gonna be a direct expense. This is and these are more indirect expenses that have to be allocated between personal use and business use, or rental use. But things like, and also management fees, 100%. You're not gonna allocate that, because it's a direct expense for the rental. Travel fees, depreciation as well, you're not gonna allocate that. Or actually, no, you are gonna allocate that, I'm sorry. They didn't allocate it here because the depreciation would be included last. So if it brings you, if it's personal / rental, you're not gonna get to go below 0, and so their depreciation did not apply. As I said here, the depreciation 79, however, the deduction is limited due to the remaining rental income. So that's why it's saying that thing. All right. Okay, so that's allocating based on one property being used part-time, right, for rental. So we're allocating based on time usage. It's also possible for one property to be used at the same time for multiple purposes. So for example, a duplex. If you own a duplex and you live in half of it, but you rent the other half out, this requires another form of allocation, but it's based on the size of the property because it's being used 100% of the time, right? So again, you've got to allocate it, but you've got to allocate it based on kind of like our home office use, right? We've got to figure out how much is being used for rental purposes versus how much is being used for personal purposes. Multifamily residential homes is what we're talking about here. So here we've got Guadalupe owns and lives in a fourplex of identical 2-bedroom units in Anaheim. The entire fourplex had $100,000 of expenses. She allocates 3/4 of the expenses to the Schedule E, deducts 25% of those in rental expenses. I'm sorry, 75,000 of those in rental expenses. The remaining 25,000 would be considered personal, and the only parts that would be deductible to her would be like the mortgage interest, if it's her personal residence, and the property taxes. But again, she'd only get to deduct 25% of it on her Schedule A. Let's see. So here's an example. This is what it looks like Ellen and Sherry Masters, and they've indicated here they're using the IRS method for allocating their expenses. So same address, single family property. Now it's fair rental days of 84, personal use days of 22. In the original, the other example, it was 100% rental property, so they could take 100% of the expenses. But here they're explaining that no, it is a personal / rental or rental / personal property. So, and they're going to use the IRS method for calculating what those expenses are. So, same, it's just the numbers would be a little bit different. So the IRS method up here results in, well, 0 income. The tax court method also results in 0 because they can't, both of the methods and the expenses were enough that it absorbed all of the income. Let's see. So I thought they gave more examples of the allocation. There's really just the one. Do I need to go into more detail about like the allocating it based on space? I mean, like I said, it's very similar to the business use of home allocation that we use. It's going to be based on square footage. So if you have, and then all of those expenses will be allocated, well, I shouldn't say all the expenses. If there are direct expenses associated with the property, like you had to repair a sink in one of the units, that's gonna be 100% repair on that rental repair, if it's in one of the rental units. If it's in your personal part of the property, then none of it's gonna be deductible on the Schedule E, right? But for the rest of it, those expenses that cover the entire building, then you apportion it based on square footage. Okay? All right. No questions?